Hey, it's been about a week since OPEC's bombshell announcement, and it's been about 4 weeks since the tariffs went into effect. How's the market reacting? Let's get into it this week in oil. Hey, I'm Aaron from the Oil Balance, and I'm here to elevate your understanding of the oil market. All right, well, let's jump right into the charts here this week. I've got some really interesting things to go through with you. So, WTI futures actually bounced back this week. Here we're looking at a daily chart. I normally like to look at a weekly, but I think the daily is pretty interesting. So, the last 2 days, Friday and Thursday of this week, we've had a really nice bounce back. We got above 60 here today. And we're still within this range that we talked about last week, that I think that's going to be sort of the new range here for a little while. We'll see how that goes. But it puts us again at a very interesting position as far as producers are concerned, calling it sort of a yellow light sort of position. And you'll see why in a minute. I think maybe I had hopefully been referring to it that way previously, but with some comments this week, I think you'll see why that's actually maybe a really good way to think about it. So we're not back in terms of growing production like crazy, like we were, back here when we're sort of around $70 and that sort of thing. But it's actually a really interesting sort of financial position to be in. And gasoline futures, there was some hope that with this sell-off that gas would get really cheap at the pump. It's not quite doing that yet. Maybe we just need a little bit more time. But those have bounced back pretty good as well. So again, here we're looking at front month gasoline futures. And this is, again, a daily chart. So a big move up yesterday, kind of a little bit of a doji here today. But actually stronger if you look at versus where the peak was in late April. Gasoline's actually caught up to where we were sort of at the end of April already. So a little bit stronger move. Gas cracks are actually looking pretty good. So here they are. Gas cracks are actually looking pretty good on both counts that I have here for you. This is Gulf Coast CBOB versus WTI and New York Harbor gasoline versus Brent. Some of what's going on is you just saw that I think gasoline is performing by itself, but then you add in a relatively weak crude market, and these margins are going to look really good. So again, what this is supposed to be is sort of a quasi look at what the refiner sees, where you have the gasoline output versus the crude input and what that spread is between them in terms of dollars per barrel. And you can see both are pretty healthy. The New York Harbor is still sort of on the bottom end of the 5-year range, and we'll show you some inventories here in a minute that maybe will make a little bit more sense. Diesel fuel, though, is kind of just keeping up with a year ago. We've been trending down 2 weeks in a row now on Gulf Coast on Gulf Coast prices on those margins, and sort of flattish on the East Coast for New York Harbor. In terms of California wholesale, again, we've been looking at diesel fuel as maybe a canary in the coal mine in terms of the tariff. So if there aren't as many ships coming in, you're going to see a drop off in diesel prices, because there's just not that much demand to move things around once you get the vessels unloaded and they have to get whatever those products are to market. There's a lot of diesel demand that goes into that. So if we see a dramatic drop in vessels coming in, we should see a sort of a commensurate drop in diesel prices, at least in LA, where some of the biggest harbors are in the US, for biggest ports for bringing in goods. And we're seeing it a little bit. But again, this isn't too much different than what we're seeing on the Gulf Coast. So there is some weakness in the diesel market right now. And again, like I mentioned, there are some big concerns across the diesel market as to what's going to happen as the tariff situation sort of evolves. We do have tight inventories. So PADD 2, we're still in the middle of planting season, and inventories have drawn down very quickly on PADD 2 diesel stocks. Distillate is just sort of a bigger catch-all for diesel fuel, but that's primarily what it is. Gulf Coast gasoline, PADD 3 gasoline, has been below the 5-year range here these past 2 weeks, so that's still looking pretty tight. So as I mentioned, it seems like gasoline has some strength on its own outside of what the crude market might be doing in terms of bouncing back off the lows that we saw from the OPEC news. And then Cushing inventories are still very low. And again, this is the delivery location for the WTI contract. So I think it makes sense that we're still seeing some backwardation in the front of the market. I'll explain that here in a minute. And maybe some of why price actually bounced back, because inventories are pretty low in the US still. So I mentioned before, it's been about a week since the OPEC news hit that they're going to ramp up production. OPEC Plus, I should say, ramping up production. I thought this summary really was effective. This is from the CEO of Diamondback Energy. I'll read it for you in case you're not on a cell phone or something, you can't read this, but he says, to use a driving analogy, we are taking our foot off the accelerator as we approach a red light. If the light turns green before we get to the stoplight, we'll hit the gas again. But we are also prepared to step on the brake if needed. So I think, again, like I said before, the yellow light analogy, I think, is probably pretty good for where we are right now. It's sort of around $60. If we were to stay at $60 for a period of time, or even below $60 for a period of time, probably weeks, if not months, maybe these guys will change their tune and start to change what they're doing as far as production. I want to mention, though, real quick, if you subscribe through the oilbalance.com, the Elevate Your Understanding subscription, in this week's presentation, we go into a lot of detail about different shale producers and what they're looking at. The takeaway, the summary is, I looked at 5 or 6 different guys that have their earnings reports out here recently. They represent about 1.6 million barrels per day of production, predominantly in shale areas in the U.S. And they're scaling back their growth targets, but they're not calling yet for growth to go negative. If that makes sense, for to be guiding production lower year on year. They're still guiding it higher year on year. Some of them have unchanged from the end of Q4. We're seeing a lot of budgets getting cut, but we're talking 2, 3, 4% cuts in budgets. So not super huge just yet. It does seem like the groups that I was able to go through, the companies that I was able to go through their earnings calls and their investor presentations, it seems like they're fairly decently hedged at this point. Time will tell how they want to weather this storm, but I go into all that detail on the Elevate Your Understanding subscription on the oilbalance.com. If you want to go there, there's a button you can click, send me free info, and I can put you on a trial subscription for that if you want to see this information yourself. So there's a couple different ways, assuming that we are going into an oversupplied situation with this OPEC increase, which is what the market has reflected in the sell-off. So yes, we have bounced off of sort of a $55 low, but we're only back up to 60, and we're giving producers sort of a yellow light in terms of, maybe we don't want you to be producing super big amounts like you did the last couple years. So there's a couple of things we can do to manage that inventory, assuming there's sort of a globally supplied, global oversupply situation. So one is the market is starting to flip into contango. So what that means is the forward contracts is worth more than the nearby contract. So if we were to sort of skip forward and say, let's pretend we're in December of 2025. That's what Z means in futures speak. The next contract, January of 2026, is a little bit more expensive than December. By the time you get out to June, you're talking $2 or $3 more expensive. At some point, if this contango continues, we'll get to the point where month over month, the shape of the curve actually pays for your storage. So from a trading standpoint, you have potentially storage on your books, on your P&L. That's a sort of a fixed monthly cost. There's additional costs from moving barrels in and out, but let's just talk about the shell storage right now. There's a monthly cost associated with that. If the month-on-month spread is worth more than what that cost is to store, then you're going to utilize that and you're going to try to store more barrels than maybe you otherwise would or you would want to. We're backward dated right now in the front end of the curve. So you've got about 40 cents, where the front month, which right now is June futures, is about 40 cents more expensive than the second month, which is July, which is giving you a bit of a different signal, right? It's telling you need to sell barrels now out of storage to get the most amount of money for it. If you're trying to sell something in the next several months, you would want to sell June crude the way this forward curve looked as of yesterday. So hopefully that's clear as we move into, if we do move into a contango market like we're starting to see in 2026, you can see a few weeks ago, call it 3 weeks ago, 2026 was really flat. There was no contango in there. They're just pricing it as being flat sort of month on month. Now all of a sudden they're saying, well, maybe there might be some oversupply and we need to price it accordingly so we can start to accumulate those barrels, if you will. So that's one interesting thing going on is, as you just saw, inventories are really low in the U.S., especially at Cushing. So there's going to be a bit of a mismatch potentially for a little while between the international Brent market and the Cushing WTI market. So to keep in mind, the Brent market is sort of the big international market that's pretty straightforward and easy to get into if you're trading futures. It's as easy or easier than trading WTI. The tricky thing is on delivery. One, it's a cash settled market. Two, the underlying sort of pricing mechanism that helps them determine what that cash price should be is a little more convoluted with the dated Brent market, and that's a subject for a different video. But suffice to say, it's vessels full of oil that set the price as you get towards the end of the delivery period, as you get towards the end of the month, versus WTI futures on the NYMEX, where you're looking at making or taking delivery into storage tanks in Cushing, Oklahoma, in the middle of the country. So on one hand, you've got landlocked tanks. On the other hand, you've got vessels on the ocean. That's why we say the Brent market is more of an international market, because obviously on a vessel, you can take that anywhere you want. It's a little bit harder to get out of Cushing, Oklahoma. I mean, there's pipelines and everything, but it's to try to get that barrel eventually to Asia or to Europe requires quite a bit more work than it would on the Brent market, which is where we come to this chart over here. So this is looking at WTI minus Brent. I want to remind you again, if you go to our website, theoilbalance.com, and do a trial request for our Elevate Your Understanding subscription, I have a whole page sort of dedicated to this in more detail. Maybe it'll make a little bit more sense, but I'm trying to summarize it here for everyone on the YouTube channel. But what has happened essentially is since 2015 is when we were first allowed to start exporting it to places other than Canada, basically. To make that happen, we had to price ourselves low enough that you could open up that arbitrage, so to speak. So if you think about trying to make money moving a product from A to B, if you start at point A, you need that to be cheap enough to cover transportation, to keep people interested in buying your product versus something else in location B, if you will. So there's different things that go into the arbitrage. Of course, there's the cost of the vessel. There's the quality of the crude versus the quality of the crude at the destination, all this sort of thing. But the big takeaway is, since 2015, primarily, there's been some times here where this is not true, but primarily since 2015, we've been in a situation where WTI is at a discount to Brent, primarily because the marginal barrel gets exported. On the other presentation that I'm keep referencing that you can get a free trial for, you can see some of the dot plots that I have. It has very strong R squared between shale production and exports. As I've been saying for a while, the marginal barrel of shale gets exported, not run in a U.S. refinery. So if the politicians really wanted to do something, they could encourage more CDU capacity capable of consuming the shale we produce. That's a solution. Maybe not the best, but it is a solution. At any rate, what I'm concerned is that the Brent market, the international market, is under pressure because OPEC is selling barrels primarily on water to these foreign countries. So it's the international vessel-based market that's arguably getting hit harder than the storage tanks in Cushing, Oklahoma that are, I don't want to say running on fumes, but they're very low. So you have this sort of dynamic going on. And what's happening is that we're starting to price WTI at a smaller and smaller discount to Brent, primarily because Brent's coming down and WTI is coming up a little bit, again, trying to price in the backwardation, trying to price in low inventories and that sort of thing. So that could be one really interesting lever that the market could pull, speaking sort of in broad generalities. If the market were to close this export arb, then you would almost certainly have to go into some sort of contango or carry market where the market was paying you to store barrels in the U.S. The other solution is the Gulf Coast markets that are sort of the last step before you get on a boat. So the MEH market, there's a Corpus Christi market as well, where they have different values for essentially a WTI or a shale type barrel. those are going to have to weaken to compensate for what the futures are doing, to be able to open that arb to make the arbitrage make sense, to make the export barrel make sense. That's a good thing for refiners too. Those refiners on the Gulf Coast who are capable of running maybe a little bit more incremental crude, incremental shale crude, that will obviously help them in terms of that margin we were looking at before. So some really interesting things capable of going on. Either way you cut it, we should be increasing refinery demand over the next 4 weeks or so as we get into June, especially in the Cushing, Oklahoma area. I believe Ardmore refinery is still offline. That's sort of the last Cushing area refinery to be down for planned maintenance. And when that comes up, again, that should increase demand in that Cushing area where stocks are already pretty tight, which could have the effect of pushing this Brent TI positive potentially in terms of WTI being at a premium to the Brent market. So some really interesting things to watch for there. I go into it in more detail in the other presentation, but hopefully that suffices for now to let you know what's going on. Domestic demand is actually doing really well when you start to combine it all together. We're up about 2.9% year on year. I do have to note, though, that last year in Q1, diesel demand was pretty bad. And so to say we're up 2.9% year on year versus a bad Q1 number from last year maybe isn't the most heroic thing going on. But you can see these last couple marks, maybe these last 5 marks that we've gotten on the weekly data actually look pretty darn good. And that's especially important going into these tariffs and all that sort of thing starting to hit the market. Diesel demand is still a concern. Jet demand actually looks really good. Gasoline demand actually looks really good. So from a refining standpoint, things look good. Individual markets like diesel, I think it's still sort of up in the air. So let's see what else we have here. So this is a port optimizer. This is the Port of LA. The top bar is from last week. This lower bar is from this week. So the way we need to look at this is last week they were saying week 19, they were projecting 72,000 TEU. The way it's coming with the updated numbers from this week, we're actually looking closer to 76,000 TEUs. So that's a good improvement. 76,000 is still somewhat a low number. If we look at their projection for May 20, as we were commenting last week, this number is probably too high. And yes, they have revised it down to 87,000 TEUs, rounding up. 87,000 TEUs is looking a bit more normal. It's a bit like week 18 that we saw back here. And then the forecast for week 21 is absolutely huge. Again, this probably gets revised down as we go forward, just like the week 20 got revised down this week. So diesel demand might be okay. It might make it through this. We'll have to see wait to see what further impact happens. But it seems like these port numbers are actually looking pretty good, at least from the Port of LA. In terms of average retail price, as I mentioned, gasoline sort of looks strong on its own, especially from a Gulf Coast perspective. And we actually saw an increase of just over a penny per gallon on the national average week on week. So if you're frustrated thinking, man, I thought gasoline prices at the pump are going to go down. No, you're not hallucinating. They actually went up on a nationwide average. Diesel fuel continues to trend lower. It probably should be trending lower right now, this time of year, as we transition out of the springtime, out of any winter sort of demand. Inventories are still low, though, as we saw. So I don't think they'll get too low. But again, that's something interesting to think about here. We thought we would get this sort of tailwind maybe in the economy from cheap gasoline prices. And year on year, yeah, we do have cheap gasoline prices, but I was thinking, maybe you were too, thinking that prices would continue to sort of drift on lower as we go through the summer. So I put in a summary this week. Hopefully it helps you guys. So WTI back above 60 for now. Gasoline still looks pretty strong. U.S. producer response muted so far. Again, it might be a little bit too early. I thought that the CEO of Diamondback made a really good comment that I think is useful for us at this point in time anyway. I went through the different stages of how the crude market could deal with an oversupplied situation, especially the U.S. market. And then demand still looks pretty good overall. There still are some diesel concerns, maybe we're making too much out of them. At least that port data makes me think that maybe demand's going to be better. So we'll see. Anyway, that's what I have for you this week. Again, if you go to the website, theoilbalance.com, there's a button you can push that says send me free information. I'll be happy to send you this presentation. I'll be happy to put you on a trial for the more detailed version of this as well. But at any rate, hope you have a good weekend, and we'll talk to you later.